This is the beginning of part 3 of our module on market risk management and value at risk, which teaches you to identify price risks for traded positions and to use value at risk, or VAR, to quantify an entity's exposure to a specific risk factor or portfolio of risk factors that can adversely impact financial performance. We remind you that this part 3 contains one chapter only, chapter 5, which provides a detailed exposition of the Basle standardized model for market risk measurement and capital allocation, and briefly summarizes some of the guidelines regarding the alternative use of internal models for market risk. The main objective of the Basle market risk framework is to measure with reasonable accuracy banks' exposures in their trading portfolios and to regulate those exposures by imposing capital requirements against their market risk. Under Basel regulation, banks may implement an internally designed market risk model based on any of the 3 approaches presented in chapters 3 and 4. Alternatively, they may use a standardized model specified by the Basel Committee. This second option is targeted at smaller institutions lacking the know-how, systems, data, and personnel to design their own internal model. If the institution opts for the first alternative, a number of specific tests need to be satisfied, in addition to frequent regulatory audits. A word is in order to clarify why the trading book is treated separately from the banking book under Basel regulation. In the banking book, assets such as loans and bonds are recorded at amortized historical cost, and fluctuations in their value in the secondary market are ignored unless those assets become impaired. Thus, a AAA bond purchased at par continues to be valued at par in the banking book, even if its credit rating drops to AA and its secondary market price diminishes. In the trading book, however, the decline in the price of this bond would be reflected on the balance sheet, and the income statement would similarly show a loss equal to this decline in price. This income statement loss works its way into the right-hand side of the balance sheet by depleting retained earnings, thereby reducing equity. Thus, any gradual deterioration in the value of the investment works its way, period by period, into the equity account on the balance sheet via the income statement first. Since trading book assets, being by definition liquid and frequently traded in the secondary market, impairment in their value over time reduces capital on a gradual basis and do not result in sudden hits to the bank's capital, in contrast to credit losses in the banking book. Furthermore, since the item is quite liquid and is recorded at fair value at any moment in time, management can decide in an emergency to liquidate the position immediately and would see the institution's capital from that point onward diminished only by any further drops in its value prior to successful liquidation. Capital is therefore required only to absorb some estimate of what, in a worst-case scenario, subject to some confidence level, projected losses on the position are likely to be over the time period it will take to liquidate the position. This number can be much lower than the usual 8% capital requirement that applies for banking book positions. We begin in this worksheet BIS fixed income with fixed income instruments and illustrate the so-called Basle maturity method by means of a detailed example. Cells B6 to F20 list the institution's long and short positions in debt instruments of various quality, grouped together by time bands, also known as maturity buckets, that are specified in the rules. Elsewhere in this table, the entries in cell G6 to G20, I6 to I20, and K6 to K20 are also inputs mandated under the rules, which we will explain next. In the remainder of this chapter, we summarize the application of the standardized model for each major asset class. More details can be found on the website of the Bank for International Settlements at the link you see here. We warn you that the rules are complex and require your full attention, so we provide a quick roadmap to them first. The rules acknowledge that trading books are often long and short similar instruments, whose price risk therefore offsets to some reasonable degree, but not entirely. The residual risk in such cases may result from differences in instrument maturity, or differences between the identity of the underlyings, which create some amount of basis risk, as it is called, or in some instances technical pricing considerations that apply especially to commodity derivatives, and again leave some residual risk that should be taken into account under the standardized approach. The rules therefore allow substantial long-short offsets in the calculation of the net price risk for the institution, but require some minimum capital to be reserved on account of these residual risks, even when the long and the short would otherwise neutralize one another completely. In the specific case of fixed income instruments, the degree of allowable long-short offsets is highest for instruments having substantially similar durations, and lower for instruments with greater differences in their durations. It is also highest between bonds of a solid credit quality and lower for bonds of a poorer credit. To achieve all this, instruments are initially separated into buckets and sub-buckets on account of their maturities, offset to the degree specified under the rules, and then offset again against each other across the different buckets but again subject to specified limitations. For all instruments, the capital charge for basis or other residual risk is set to reflect the anticipated magnitude and volatility of these residual risks. Option positions, finally, are included in this framework as long or short positions in the underlying, based on the instrument's delta equivalent, and then treated like other instruments to a large degree. Additional capital charges, however, are also imposed on account of options vega and gamma sensitivities, based on formulas provided in the rules. Finally, inter-asset correlations are largely ignored in the interest of simplicity. That is to say, capital charges are added together at the end of this process, denying any benefit for diversification across different asset classes. In terms of credit quality, the rules distinguish between government securities, qualifying securities, defined as investment-grade debt instruments, i.e. rated BBB- and above, issued by non-sovereigns, and finally non-qualifying securities, defined as below investment-grade debt instruments, and again issued by non-sovereigns. Basel imposes two capital charges on account of the market risk of these instruments. The first capital charge required is a specific risk charge that reflects the credit risk specific to this instrument and issuer. Weights for this specific risk component, as mandated under the standardized model, range from a low of 0% for government securities to a high of 8% for most non-qualifying securities, and even 12% for non-qualifying securities having a very low credit rating. For qualifying corporate debt, weights are 0.25% for maturities of 6 months or less, 1% for maturities between 6 and 24 months, and finally 1.6% for maturities exceeding 24 months. In cells H6 to H20 of our worksheet, the capital charge for each position is calculated simply by multiplying the weight of the position by its absolute value in currency units. The second capital charge required is a general market risk charge appearing in cells J6 to J20, equal to the position values in cells F6 to F20, in each case multiplied by weights mandated under the standardized model and appearing in cells I6 to I20. Intended to reflect the sensitivity of each instrument to pre-specified interest rate movements, these being the items listed in cells K6 to K20. Note that the weights for general market risk depend exclusively on the instrument's tenor and not on its issuer, with longer tenor and therefore higher duration instruments attracting higher weights. Note also that the assumed yield movements in cells K6 to K20 diminish as tenor extends. Confirming the reality that long-term interest rates are less volatile in yield terms than short-term rates. Of course, this lower volatility in yield terms is more than offset, typically, by the higher duration of the underlying instrument, resulting in a greater price volatility for the longer instruments, and hence larger entries in column I for the longer term instruments. The rules now permit the netting for purposes of this capital calculation of long and short positions within the same maturity bucket, but limit this effect in recognition of the reality that the impact of interest rate movements, even within a single maturity bucket, is likely to be different for issuers of different credit quality. This is usually referred to as basis risk and requires adjustments, that is to say additional capital charges, known under the rules as vertical disallowances. For example, in the 10 to 15 year maturity bucket, the institution is short $1,500 of government securities with a general market risk charge of $67.50 and long $1,000 of non-qualifying securities with a general market risk charge of $45. Under the rules, these two positions may not be netted against each other entirely, as we appear at first to be doing in the cell J22 when we add their capital charges from cells J6 to J20. Instead, the rules impose a vertical disallowance calculated in cells B25 to J28. First, cells C26 to F28 list for each maturity bucket the positive and negative market charges copied from cells J6 to J20 relating to the long and short positions, as the case may be. Cells G27 and G28 then calculate the net difference between these charges, although this net figure will not be used until much later. And finally, cells H27 and H28 calculate the absolute value of the smaller of these two charges within each maturity bucket. The rules now impose a supplementary capital charge or vertical disallowance equal to 10% of the net figure to the left. Hence, the $4.5 of supplementary capital charges appearing in these cells J27 and J28 for each of these two maturity buckets. In essence, these supplementary charges address the existence of basis risk between the government, qualifying securities, and non-qualifying securities within each maturity bucket, and go on to stipulate the 10% surcharge in recognition of this basis risk. The rules further allow long and short positions in different maturity buckets and within sub-buckets to be offset against one another, but again subject to some limitations. Recognizing in particular that interest rate movements are not perfectly correlated along the entire yield curve, the rules impose additional capital charges on this account known as horizontal disallowances. The framework calculates two types of horizontal disallowances, one for mismatches within maturity buckets and the other for mismatches between maturity buckets. There are three maturity buckets specified in the rules into which all security positions must be allocated. A Zone 1, capturing maturities from 1 month to 12 months. A Zone 2, capturing maturities between 1 year and 4 years. And a Zone 3, capturing all remaining maturities. Each maturity bucket, as you can see, is further subdivided into mini buckets of successively longer maturities, appearing in column D right under the bucket's name. Thus, Zone 3, for example, is further subdivided into 6 mini buckets, listed in these cells D42 to D47, and so on for the other 2 buckets above. Horizontal disallowances within a maturity bucket reflect the imperfect correlation of interest rates across the mini buckets within that bucket. The procedure for calculating the horizontal disallowances is similar to what we described for vertical offsets. For Zone 1, for example, cells E31 to F34 list the net positive and negative charges from cells J6 to J20 related to the long and short positions, with fully netted amounts appearing here in cells E35 and F35. The calculation of these net amounts appears to give effect to the offsetting price risks of long and short positions, but as before, the rules also acknowledge a basis risk component here and proceed to slap a supplementary capital charge on its account, illustrated next for this Zone 1. For Zone 1, cell G35 calculates the difference between the total positive and negative charges from cells E35 and F35. Cell H35 shows the absolute value of the smaller of the two charges listed in E35 and F35. The rules are said to disallow 40%. That is to say, they require a supplementary capital charge of 40% of the amount computed in cell H35, hence the figure of $10.40 appearing in the cell J35. The 40% being specific to this particular bucket. Essentially identical procedures are performed for Zone 2 in cells C36 to J40, and for Zone 3 in cells C41 to J48. The only difference being that the disallowance factor for these is 30% instead of 40% as it was for Zone 1. The resulting supplementary capital charges are $9.38 for Zone 2 and $33.38 for Zone 3. Horizontal disallowances between maturity buckets also reflect imperfect correlations of interest rates, but this time between short, medium, and long-term rates, broadly defined. This time the disallowance reflects the regulatory view that a net long or net short position for any one zone again does not perfectly offset a net short or net long position, respectively, in either of the other two zones. Step 1 here requires calculation of the net position for zones 1 and 2 combined, as shown in cell G50. The smaller of the two absolute values of the net position for each zone, appearing in the cell H50, is then multiplied by the 40% to arrive at the supplementary capital charge appearing in cell J50. Which is revealed to be $9.50. Finally, the net residual amount, i.e. the amount not offsetting between zones 1 and 2 of negative $2.75 according to cell G50, is compared with the net position for zone 3, the 6875 in the cell G48, and the smaller of the two absolute values of these two amounts, i.e. the $2.75 in this cell H51, is subjected to another supplementary capital charge, but this time equal to 100% of the cell H51 entry, producing a final supplementary charge of $2.75 in cell J51. In these cells here at the bottom, finally, namely cells B52 to J59, we aggregate the specific risk charges calculated in cell H21 and reported in cell J53. Also, the general market risk charges calculated in cell J22 and reported in cell J54. And finally, the various disallowances calculated in cells J27 to J51 and reported in cells J55 to J58. To reach an all-inclusive capital requirement for the entire portfolio of $369.40. Turning now to interest rate forwards and swaps. The rules require that they be deconstructed first into long-short positions in notional cash instruments, in a manner we illustrated in earlier chapters, and these are assumed in all cases to be government securities, so that no capital for specific risk will attach to them. These notional securities are then aggregated into the overall portfolio just like real securities and subjected to general market risk charges and disallowances exactly as described for the bond portfolio. To illustrate, a FRA is deconstructed into a long and short position in government securities, one maturing on the reset date, the other on the settlement date. And again, we remind you that we ignore, for this purpose, the early settlement convention of the British Bankers Association and assume that FRAs settle at the end of the period that they cover. Swaps are similarly deconstructed into long-short notional positions in government securities with appropriate maturities. For example, a pay-fixed interest rate swap will be deconstructed into a long position in a government-issued FRN of maturity equal to the next reset date under the swap, and a short position in a fixed rate government security of maturity equal to the remaining life of the swap. Interest rate options receive a special treatment that will be discussed later in this section. This concludes our illustration for bonds and option-free interest rate derivatives. We proceed next to foreign exchange, which is deemed under the rules to include gold and for which the approach is easier. For FX, the institution must first calculate its net open position for each foreign currency, including gold, and then must convert the position into the institution's reporting currency, US dollars in our case, at the current spot rate. Net open position for this purpose is defined as the sum of the following 6 items. 1. The net spot position in each currency, including accrued interest. 2. The net forward position in each currency, including forwards, futures, and the principal exchange under cross-currency swaps, not already included in the spot calculation under 1. 3. Guarantees and similar positions which are certain to be triggered. 4. Net future revenues and expenses which have not yet been accrued as an accounting matter, but are already fully hedged. 5. Profit or loss in foreign currencies. And 6. The net delta equivalent of the total book of foreign currency options, as we will illustrate later in the section on options. We reproduce here the exact example provided in the rules. Here is a bank's FX and gold book. The capital charge for this FX book is equal to 8% times the higher of the absolute values of the aggregate long and aggregate short positions in currencies, plus 8% the absolute value of the net position in gold. In this example, this would amount to 8% times 300, the item on the left, plus 8% times 50 on account of the gold, and that comes to $28 million. Conceptually, this 8% is a regulatory estimate of the worst case volatility of FX spot within the desired confidence level, but its application only to the higher amount between longs and shorts acknowledges that some unnecessary double counting would occur if the 8% were applied additively to the absolute value of the longs and the shorts. Note the absence of tenor buckets or time bands for FX, an acknowledgement of the reality that the delta of spot and forward positions and of future FX exposures, whether stemming from revenues, expenses, profits, and losses, is more or less +1 for longs and -1 for shorts, irrespective of maturity. The inclusion of options in the list above, but only to the extent of their delta equivalents, will become clearer when we address options shortly. For equities, the rules follow an approach similar in many ways to the approach outlined previously for fixed income. The rules recognize 2 risk components again for each equity position: a specific, non-systemic risk component and a general market or systemic risk component. The rules proceed to impose a capital charge for the non-systemic or specific risk component equal to 4% of the aggregate gross position, i.e. all longs plus all shorts, when the underlying position is liquid and well diversified, otherwise 8%. This can be viewed again as a proxy for the worst case potential price change of equities, with a penalty applying to illiquid or non-diversified positions. The refusal to permit offsetting effects and instead to impose a harsh additivity principle should be interpreted as regulatory reluctance to assume any offsets in the specific risk component of equities. The regulators view the risk of losses on each leg of a long-short equity combination to be too large to permit offset when the long and the short involve different entities. For the systemic or market risk component, a charge of 8% on the absolute value of the net position, i.e. all longs minus all shorts, applies. Here, netting is allowed, reflecting the reasonable assumption that general market risk, by its very nature, is common to all equities. So longs and shorts do offset, at least in respect of this common risk element. Equity derivatives are also included here, including futures, forwards, and swaps on individual equities as well as on stock indices, after converting them into positions in the underlying instruments at current market prices. Equity swaps are deconstructed into notional long and short positions in a manner analogous to interest rates. For example, a pay the index total return and receive LIBOR equity swap will be treated as long an FRN and short a stock index. Equity options are separately addressed later in this chapter. Commodities represent the final asset class addressed by the rules, which specifically cover all physical products that are or can be traded in secondary markets. For spot commodity trading, the rules recognize the change in spot price as the most important price risk. For forwards and other derivative contracts, the rules recognize three additional important risks. These three additional risks are: first, basis risk, defined as the risk that the relationship between the prices of similar commodities alters over time. Second, interest rate risk, the risk of a change in the cost of carry for forward positions and options. And lastly, forward gap risk, the risk that the forward price may change for reasons other than a change in interest rates or spot, referring, for example, to the so-called convenience yield factor in the pricing of commodity forwards. The rules permit a variety of approaches for the treatment of commodity positions, one being the ladder approach, which we illustrate shortly via an example included in the rules and reproduced in our worksheet BIS Commodity. We first provide a synopsis of how the commodity rules work. 1. The spot risk component of long and short positions is allowed to offset, irrespective of the tenor of the position under which they arise, eliminating the need for capital charges on this account. 2. The residual risks mentioned a minute ago, namely the basis, interest rate, and forward gap risks, require a minor allocation of capital given the modest extent of these risks. And 3. Residual exposures attract a substantial capital allocation set at 15% of this net exposure, reflecting the substantial volatility of commodities as an asset class, even over short periods. We now turn to the detailed calculation on worksheet BIS commodity. Note first the entries in columns F and G, labeled respectively spread rate and surcharge on offsets. These are preset inputs prescribed under the rules, whose role in the capital calculation we will describe very shortly. Note also the segregation of positions into 7 time bands, although these bands have a lesser significance here than with fixed income. We now turn to the specifics of the worksheet. Step 1, we convert all positions per commodity into standard units of measurement, i.e. barrels or kilos, etc. Then calculate the net position in each commodity and convert this at current spot prices into the reporting currency. This has already been done by the time you reach columns C and D, since the figures you see in these columns are the currency amounts of the various positions. Step 2, we subdivide this net position into predefined maturity buckets, as we saw a minute ago. The sum of matched long and short positions falling in any single time band and reported here in cells H6 to H12 is first multiplied by the spot price for the commodity, which we have done already in this worksheet, since the positions here are in currency units as mentioned before, and then by the appropriate spread rate for the time band to capture the forward gap and interest rate risk within that time band. For example, in the 3 to 6 month time band, the aggregate long and short positions of 800 long and 1000 short, respectively, allows us to think of the 800 of longs as largely offsetting 800 of the shorts and leaving a residual unmatched 200 of shorts. The rules essentially view the spot exposure of these two $800 positions to be minimal, and therefore impose a capital charge only for the residual risks involved, calculated by multiplying the sum of these two positions, each expressed in absolute value, by the spread rate of 1.5%, leading to a capital charge in cell J8 of $24, 800 of long and 800 of shorts multiplied by 1.5. Step 3. The residual net position is now carried forward, as it were, and becomes available to offset exposures in time bands further out. For example, for the 3 to 6 month time band, the residual net position upon completion of the process in the preceding paragraph was calculated to be $200 short, 1,000 short offset by 800 long, a number which is reported again here in cell I8. This amount is carried forward to the next time band, i.e. to the 6 to 12 month time band. But since there is no net position to offset in this band, the 200 short is carried forward once again to the time band after that, namely the 1 to 2 year time band, where it offsets 1/3 of the $600 long position This results in a $200 matched position visible in H10 in the meaning that we described earlier. And to this 200, we apply once again the 1.5% spread rate to derive a $6 capital charge in cell G10. The residual $400 is carried forward in the same way as before. Step 4. Recognizing, however, that such offsetting of positions across different time bands is imperfect, the rules slap on an additional capital surcharge, this one labeled surcharge on offsets, of 0.6% of the net position carried forward in respect of each time band for which the net position is carried forward. In our example, the $200 short position was carried forward twice, so the related capital surcharge was added in both cells K8 and K9. Finally, under step 5, a 15% capital charge is applied to the remaining long or short position once carry forwards are no longer possible, i.e. once we have reached the over 3-year time band, as we can see here. In our example, in the last time band of over 3 years, a $400 long position had been carried forward and offset the $600 position, short position, resulting in a final short position of 200 in the cell I-12. It is to this final residual that we apply the 15% capital charge, leading to the $30 charge in cell K12. The aggregate capital charge in our example is $79.20, being the sum of cells J6 to K12. These steps are now repeated for each commodity. Even though the regulators recognize differences in volatility for different commodities, they have opted for the simplicity of applying a single uniform capital charge for open positions across all commodities. For commodity derivatives, including, as we have mentioned, futures, forwards, swaps, and the net delta-based equivalent of option positions, the first step is to deconstruct these into notional commodity positions and to assign those positions to the maturity buckets as follows. Futures and forward contracts on each commodity are incorporated into the measurement system as notional amounts of barrels or kilos, etc., and assigned to a maturity bucket by reference to their expiry date. Commodity swaps are similarly incorporated as series of forward positions, each one equal in size to the periodic notional amount of the contract, and each one slotted into the appropriate maturity bucket according to its settlement date. For forwards and swaps, positions are considered long if the institution is receiving floating or spot and paying fixed, otherwise short. This concludes our discussion of the treatment of commodities and option-free commodity derivatives under the standardized model. We finally turn to the rules addressing option positions, which apply across all asset classes with subtle differences between asset classes. A number of approaches are permitted for quantifying option market risk and calculating the associated capital charges, and these charges are additional to those for the underlying asset classes. These approaches are known as the simplified approach, the scenario approach, and the delta plus method. We outline only the delta plus method in the interest of time. The delta plus method requires the institution to integrate option price risks into their underlying asset class positions, i.e. rates, FX, equities, commodities, by first multiplying the market value of the underlying assets by the delta of the option and treating the result as if it were a simple spot position. The institution is required, second, to measure gamma and vega sensitivities for all option positions and apply additional capital charges on account of these sensitivities before arriving at the total capital charge. By way of a quick reminder, gamma measures the rate of change of delta, and vega measures the sensitivity of the option value to a change in implied vol. For options whose underlying is an interest rate instrument, such as swaptions, caps, floors, and bond options, the delta-weighted amount of the underlying is treated just like a spot position and is therefore slotted into the appropriate interest rate time band or bands described under the maturity method, pursuant to a two-pronged approach. One entry is required in relation to the reset date for the underlying, and the second entry is required in relation to the settlement date of the underlying. To illustrate, a 6x12 long LIBOR caplet position with notional of $10 million and a delta of 40% is integrated via the maturity method that was described on worksheet RS-FRA as 1. Long a $4 million, note the delta, 6-month government security, and short a $4 million 12-month government security. The capital charges for options on equities, commodities, FX, and gold are in the same manner based on their delta equivalent underlying positions and integrated into the total capital charges described in the earlier sections for each asset class. The additional capital charges on account of option gamma and vega are calculated as follows. Each individual option position requires calculation of a gamma impact defined as 1/2 of gamma times VU squared, where VU represents the variation of the underlying of the option. VU itself is calculated as follows. For interest rate options, the calculation is based on the assumed changes in the relevant yield level that were set out in column K of worksheet BIS fixed income, specifically cells K6 to K20, which we reproduce here briefly for your convenience. For options on equities, FX, and gold, the market value of the underlying is multiplied by 8%, while for options on commodities, it is multiplied by 15%. For purposes of these calculations, the following categories of instruments are aggregated and treated as having the same underlying. In the case of interest rates, all instruments within each maturity bucket set out in worksheet BIS fixed income. In the case of equities and stock indices, all instruments traded on each national market. In the case of FX and gold, each currency pair and gold. And for commodities, each individual commodity. The individual gamma impacts are then summed, resulting in a net gamma impact for each underlying that may be either positive or negative. the total gamma capital charge is set to equal the sum of the absolute values of only the net negative gamma impact. Positive gamma impacts are not included, since a long gamma position can only bring gains, never losses. Turning to vega risk. The capital charges are set to equal the sum of the vegas for all options on the same underlying, as defined just a minute ago, multiplied by a proportional shift in volatility of plus or minus 25%. The total vega capital charge is set to equal the sum of the absolute values of the individual capital charges for this risk. After integrating the option-related capital charges into the capital charges for each asset class in the manner we just described, these charges are aggregated, leading finally to the all-inclusive capital requirement for market risk for the entire trading book. By simply aggregating these charges, as we saw in Chapter 3, the rules are implicitly assuming that perfect correlation exists across all asset classes, an erroneous assumption that is tolerated nonetheless in the interest of preserving the simplicity of the standardized model. We make a few final observations before concluding our discussion and arriving at the quiz. Basel does not impose its standardized approach on banks. To the contrary, Basel encourages banks to develop their own internal market risk models, at least for the more sophisticated institutions, based on the three methods discussed in earlier chapters. Basel does, however, impose three continuously monitored tools to ensure that any model adopted is conceptually sound. These are stress testing, backtesting, and external validation. Stress testing is used to assess the capacity of the institution's capital to absorb potential losses and to identify strategies to reduce risk and conserve capital, incorporating both market risk and illiquidity aspects of market disturbances. There are three aspects to a robust stress test. 1. Compare the capital charges derived using an internal model to the largest losses during the reporting period, to develop a sense of how many days of extreme losses can be absorbed by the VaR estimate. 2. Test the current portfolio against actual past periods of extreme stress, such as the 2007-2008 credit crunch, to evaluate the sensitivity of market risk exposure to changes in the volatility and correlation assumptions. And 3, conduct stress tests by using low probability events in all major types of risks: market, credit, and operational risks. Backtesting requires a comparison of estimated VaR with actual trading results and a determination of whether these results are consistent with the targeted confidence level, which is 99% or 95% usually. The 99% confidence level for daily VaR means that losses in 99 out of 100 days should be lower than the estimated VaR. If actual daily losses exceed the this estimated VaR any more frequently, an assumption arises that the model used underestimates the risks of the trading book. In such cases, the institution will usually be required to increase the multiple it applies to its daily VaR to reach the capital charge from the normal 3 to a maximum of 4, depending on the frequency of instances in which losses exceeded the stated VaR. If conversely actual losses exceed the estimated VaR less often than expected, a converse assumption arises that the model overestimates risk. While this latter phenomenon may not be as worrisome as the former, it does raise questions about the reliability and accuracy of the model and is not dismissed by regulators without further investigation. The Basel rules finally require external validation of the accuracy of internal models. Users of internal models are required to satisfy several sets of minimum qualitative and quantitative criteria outlined in the market risk framework, but their detailed examination lies outside the scope of this module. We conclude with a word of caution. The extensive mathematics we have relied upon throughout this 4-part discussion of VaR may give you the false impression that risk measurement and control are principally a matter of applying correctly a finite number of mathematical formulas, and that risk managers who master these formulas will be certain of a successful risk management process. Experience from the financial markets has shown clearly that on many occasions, however, simple common sense may be as relevant at least as the correct mastery and application of the mathematics. Risk managers cannot and should not adhere religiously to their VaR models. Rather, they should constantly question the outputs of these models and make judgment calls as to their relevance and accuracy, especially during unusual market conditions. It would be unrealistic to capture all facets of risk measurement through simplified systems of equations. VaR models certainly increase our appreciation of the complexity of the risk management process and provide a consistent methodology with advantages and drawbacks to facilitate the effectiveness of this process. But in many instances, the skills needed for success are more relevantly those of the jaded and skeptical artist than of the numerate science expert. This completes Chapter 5, as well as Part 3 of this module, and brings us to the quiz in the final chapter, Chapter 6.